read this disclaimer. Morning, good afternoon, good evening, depending on what time you're watching this video. This is Ed FX Trader with a very important video. Now, I want to say from the get-go that this video is going to be lengthy, but I've had a couple requests of people asking me, what exactly do I do? So I had a friend of mine asking me to send videos as to what I look for to determine a winning trade. How do I analyze the charts? Do I employ multiple strategies, or do I just stick to one? And those questions are going to be answered over time, because with the wealth of knowledge that I have, I do at times apply multiple strategies, but my trading methodology remains the same. And so I want to get straight into it. Now, I want you to pay attention to this video because it is going to show you exactly what I do. So first thing first, we're going to focus on one currency pair, which is the euro versus the Australian dollar. And we're going to focus on this pair for like the rest of the year, because I want to drill the formula. Remember, success is not a fantasy, it's a formula. So we want to drill the formula over and over and over, and to show you how you can just stick to one currency pair, one strategy, and to show you how it works. And as my trading evolves, I'm learning more and more to just stick to one strategy, keep it very simple, because I'm realizing that less is more in Forex. All right, so let's get straight into it. And while I'm going to seek to answer the question, whenever I decide to trade, there's a process that I go through, first of all, to determine which currency pair I'm going to trade. But because we're going to focus on this one, this is one that I am trading right now. I've already made some money on this particular currency pair, but I'm going to show you exactly what I do. Whenever I decide to trade a currency pair, I first go to the currency pair and go to the monthly time frame. And whenever I go to the monthly time frame, the purpose of me going to the monthly time frame is to determine direction. I want to get a bigger picture, so I zoom out to see what exactly is happening. Right, so I will just take a bird's eye view of the currency pair and to just see. I will zoom in and out just to see what is happening. And we're going to use our 5 steps to trading. Now, the purpose for me zooming out is to try and determine the pattern that is at work. What has the market been doing, and what is the market currently doing? And I'm going to use some of my technical skills to see what exactly is happening. Now, one of the major benefits when it comes on to analyzing the market is looking left. Now, when I look left at where price is currently at this gray line, when I look left, I see something unique. I'm going to put a horizontal line right here. I see something unique in and about this region. I'm going to just create a little area here so that you can also see it. Make this line a little thinner. Right? I look left, and when I look left, I see something very unique. One of the things that is very unique about this, let me remove this one, is that the market tends to U-turn in and around this line. That's what's one of the major things that I look for. So I first go to the monthly time frame, I zoom out to see what is happening. So just quickly, if you look carefully, if I go left, notice that price is right here, but I'm going to go left. And I put a horizontal line right where the market is at. I see something unique, and I hope you see too. Whenever the market is around this line, it tends to do something. The market, first of all, likes to gravitate towards this line, right? But whenever it reaches this line, you see that it pushes the market up. So when market comes here, pushes the market up, pushes it up, pushes it up. It breaks through and it comes back. Then it comes here, it pushes the market up. So whenever the market is above this line, it tends to push the market back up. So in other words, this area is an area of what is called support, right? It's an area that holds the market up. Whenever the market breaks through it, which it broke through it really and truly right here, right? It then comes all the way down, but it gravitates back towards this line. Now, what is happening is that the market, this line or this price point is now pushing the market down, right? You can see that it is pushing the market down. So that which was acting as support way back here is now acting as resistance. That's a key point to deciding to trade, right? So I normally look for a line like this or a price point like this that the market tends to U-turn. It tends to gravitate towards this. Even when it pulls back far away from it, it still gravitates back towards this line. So that tells me something. All right, this line is like a magnet. The market will go towards it. Having realized that, my trading becomes much simpler because guess what? Right now, we are in and around that line. So the market has history, and that is what we always use. I always use what the market tends to do in the past is what it will tends to do, because really and truly the market just operates like a cycle, right? So that is one thing. So now that we realize that we're at this point, the next thing that I do is that I now zoom in a little closer in terms of my spatial intelligence, and I'm going to ask myself, okay, well, if this is the area that pushes the market down, what now is happening? So I'm going to remove a couple of these lines, and these arrows rather, and I'm going to figure out, is there any other pattern? So I look a little bit closer. I'm going to move this line to about here, right? I look a little bit closer and I notice something else. Like I said, all of this is spatial intelligence so far, and that's all. This is what I spend my time doing firstly, but I do it very quickly because it's easy for me to see it. I then also see the market moves. The bulk of the last couple of movements in recent years is within this rectangle. So if you look carefully, the market goes up, up, up here, up there, and the market comes down, down, down. So this is also in line with the overall picture that we saw when we zoom out, that around this price point, around this line, the market gravitates and it pushes the market down. It has been pushing the market down. This is what we call consolidation. This gray area is what is called consolidation. It means that the market is consolidated. It is kept within this range. So within this price point, 1.6048, and down here, let's call it 1.37, right? The bulk of the last years of movements have been within this price point. Okay, so that's a second reason that gives me that the market more than likely, probability wise, is going to go down, because one, we see that this line up here pushes the market down. This price point 1.60 pushes the market down, and we are at that point. And then we see that in recent years, right, the market has been in consolidation and it is at the top, right, the resistance, right? So I use that as well. Then I'm going to zoom in a little closer. I'm going to go to a different time frame to highlight this particular point. I zoom in and look at last year 2018. If you zoom in and look a little closer, you're going to notice something. Within the bigger consolidation, there is a smaller consolidation. And I'm going to put this in green just to highlight this area. If you look here between that green line there and this green line here, you will see another consolidation. Up, down, up, down, up. We're going to expect it to come down. Now, let me carry this. Let me open this on a different time frame so that you can see it a little more. Let me just go to the daily time frame here, or probably the weekly, and I want you to see this. Okay, let's just look at this. All right, I want to zoom out and just look a little closer. You want to see it. If I do the horizontal line here, I can see it. This is where we are. I don't know, this something seems wrong with this broker's thing. Something seems wrong with this broker. I'm not getting the candles. Let me see something. Hold on 1 minute. Let me see something here. It is not reflecting exactly what I know is happening right now. These dotted lines, something seems to be missing there. So I am opening up another broker just to see. But while that is happening, if you just look, you can see the consolidation. It goes up, comes down, it goes up, it comes down, right? And so once that is spotted, everything else becomes very simple. All right, so having seen that, we believe that our direction is going to be down, right? We're going to believe that our direction is going to be down. But because this is not accurately representing the chart, I'm not going to use it because I know that price is more up the top, and this broker not showing that right now. While I'm waiting on this to load, let me just go to the track record here. So for this month, I'm pretty much already up 3%. And let me show you, I have traded the euro versus Australian dollar. Here it is. I sold it, and this one gave me a 1.12% gain, and here it is again. I held the trade for 10 days here. I held this one for 27 days. Right, holding a trade for a month. That is good stuff, because you have to be confident, and you have to be like, this is what you see, and you believe that it will going to work. So as you see, this is the euro versus Australian dollar. So this currency pair alone would have given me a 2.3%, right, increase on my trade, on my account, right? I don't know what is happening with that, so I am going to go to the euro versus Australian dollar. I think I have it here, but let me just bring up a new chart here, because I never liked what that one is showing, so I'm going to have to use this one and stuff. If I go to the weekly chart, if you take off the terminal, right, so this one will show it better. If you look here closely, because here we are. So this is the consolidation, right? And what we see here, like I said, the market goes up, it goes down, it goes up, it goes down, it goes up. So we believe long term that the market will make its way back down here. May take several weeks to do it, but that is what we believe. And you only can trade what you see. So having determined that my direction is down, okay. So going through the 5 steps of trading now, right? Number 1, equity management. I'm only going to risk 1% of my trading account. 2 is direction. We have already determined direction. That direction is down. Okay. We have already determined that I am, through technical analysis, I am looking to sell. So I've already determined that. Number 3 is my stop. All right. Where am I going to put the stop? Now, if I trade the highest time frame, let me see. Yeah, something's wrong with this chart. Yep. Something's wrong with that broke on the chart. I'm not even going to use it. So what position traders will do is that they will just place one trade right near to the top and they will just hold it until the bottom. Or even now, you place one trade, you walk away for several weeks and you take your profit down at the bottom. But because we don't trade like that, we tend to go to a smaller time frame. So what I would do after I determine that my direction is down is that I will go to a smaller time frame, let's say like the 4-hour time frame, and I am going to look to sell, right? But my stop, ideally I want my stop out of the range, so my stop would need to be about here, about 300 pips. Okay, my stop will need to be about 300 pips ideally. Okay, now my stop is going to be about 300 pips if I position trade it like that, right? And if I put my stop here, let's say if I'm supposed to enter here, my stop will be 300 pips and my reward will be like 500 plus pips. So my risk to reward, my reward is greater than my risk. But we want to sell as high as possible. Okay, so when I look at the market now, I already have determined my stop. Okay, now having determined my stop, if I was supposed to enter the market now, I now need to determine my entry. Okay, when and where I'm going to enter the trade. Now, because we're selling, we're going to focus on selling. Okay, I want to sell high and I want to sell high in the sell zone. All of this I go through as part of my strategy, but it doesn't take me long to do this. I'm just taking my time. Am I in the sell zone? You'd have to watch the lesson about trend lines, right? So I am clearly in the sell zone, right? This was the buy zone. The market broke and entered into the sell zone, and the market is making lower lows and lower highs. So I am in the sell zone. Now I want a high price in the sell zone. So when the market had entered into the sell zone and then it pulled back here, this would be a key entry. And then you notice that it just went down lower. So what I want the market to do now is to pull back, right? Give me a high enough price, and then I'm going to sell. If I don't want to wait for a high price, then I'll just put a counter trend line there. Whenever the market breaks this counter trend, and I will enter the trade. Okay, so that is what I look for. I look to sell high. So going back over the process, I have determined direction. I know I'm only going to risk 1% of my trade, 1% of my account, sorry. I know where my stop, ideally I want my stop to be above this shaded area. So the higher the price goes, the higher I'm able to sell is, the better it is for me, right? So, but if I was supposed to sell now, I just want to show you what I will do. I will go to here. Let's say I have an account with $5,000, right? I will go here. I will enter $5,000. I only want to risk 1%. let's say my stop loss is 300 pips. The pair that I'm trading is the euro versus Australian dollar. And then I press the calculate button. What it will do is calculate for me my position size. You understand? So that I only risk 1% of my account. So it is telling me that my position size whenever I trade should be 0.02. So I needed to determine that. Okay? If I get a better entry, let's say the market goes up higher, right? Let's say the market goes up to about here, and then I get to enter at this price point, right? Then my stop will only need to be, let's say, 100 pips. So in that case, I'll go back here and then I'll change this to 100. So I can trade a higher size. I could now trade 0.07, right? Which is 70 cents per pips, right? Generally speaking. So the higher my entry is, if I can sell high, then I can sell at a greater position size. I can make more money, right? So you would have to be patient to wait for a higher price, or you can enter one position now if you believe that the market may not give you a higher price, and if it goes against you, you can decide to enter another position, but that's a different strategy. Okay, but you can place one trade, put 300 pips stop, walk away from the trade, put your limit way down the bottom, and that's it, and you just leave the trade alone. You go live your life, go to work, do whatever it is you're doing, while your investment is going to still make money at the end of the day. So my entry, I want to sell high in the sell zone. Okay, so that's what I want to do. I'm already in the sell zone. I want a high price in the sell zone. So if the market goes up higher, that's better for me, and then I will look to sell. Now, that's how I analyze the chart. So if I see that the market is moving within this range, then ideally my take profit if I'm selling is down here, down the bottom. And my best point to sell would have been up the top. And that was what I was able to do on some of my trades. So that was why I got this one, right? I got quite a number of pips out of these trades because I was able to enter at a high enough position, right? So what I'm waiting for now is that if the market will pull back, right? So all I needed to do is to go up. Now, I guess the fundamental question that you will ask is, well, how do you know whether the market is going to pull up? How do you know it's a high price? And that becomes a matter of education, right? Now, I would like the market to go back up to about this point, and then I will look to sell. Then you're going to ask me why this point, and that I would have to share in another video, but we're taking it one stage at a time. Ideally, I want the market to go up to here and I will sell it. Okay, but I'm expecting it to pull back. Okay, once I determine those things, that is how I decide that I am going to trade. And so I'm going to place the trade, right? My entry is to sell high in the sell zone. I'm already in the sell zone. I just want the market to pull back a little more, and then I'm going to sell again, right? And then the last thing is my limit. I already know where my limit is. My limit is going to be down here. Now, if we want to trade 1 to 3, like I said, if we were to trade now, we would risk about 300 pips, and our reward will be about 500 pips. So we won't exactly get 1 to 3. So if you want a 1 to 3, you would need the market to pull back to give you, let's say, a risk in about 200, and you can go for about 400. If you don't want to enter on a daily time frame, one of the things you can do is you can go to a much lower time frame, like the 4 hour, the 1 hour, and you can do your risk to reward nonetheless. You can decide to risk less than the 300, but ideally if you put your stop outside here, you more than likely won't lose the trade at all, right? But if you don't want to risk, if you don't want your stop to be so large, you can probably decide, okay, I'm going to risk 100 and I'm going to go for 300. What I do, I just can introduce you to something, but I won't spend a lot of time on it, is that I use Fibonacci's, right? So one of the things that I will do is wait for the market right? You don't need this at all. But I wait for the market to pull back, right? At an area where there has been a little hesitation. If you look close enough, you'll see around here, there's a lot of hesitation of the market around here. So if it pulls back here or even higher, that will be very, very good for me. We can enter at a high price. But once you realize the pattern in general, right, you don't even need to go into all of this nitty-gritty. If you realize a pattern and you are trading to grow your account in the long run because it's an investment, once you realize this pattern, you place the trade, you walk away from the trade, right? Put your stop about here, put your limit down here, you walk away from the trade. Go and live your life, go to work, and just let it play out and stuff like that. You don't have to get involved in the nitty-gritty of all the technical stuff. And once you're able to do that, you'll be fine, right? And so that's essentially how it works. All of the nitty-gritty is too technical for me to get into, because without the proper education, most of it won't make sense. But what you want to do is generally find the pattern, find what the market is generally doing, and just trade. It goes up. I show you, it goes up. Right? It comes down. It goes up. It comes down. It goes up. You have no choice to believe. And this is recent. It has already started to come down. Right? This is 2019. When it was December, when we were right here, and you see this pattern, right? December 31st, you had no choice. When I spot this pattern, you have to believe that the pattern is going to hold. And so when I spotted this pattern and the price was up here, I said, but wait, I have no other choice. If every time when it reaches up here, it goes down, I'm going to believe that it will go down. But because the market doesn't move in a straight line, it won't just fall straight down. It will wave. You notice when it was down here, it went up, pulled back, then continued up, right? When it was up top here, it went down, do a little pullback, come down, pull back, but eventually it made its way down. When it was down the bottom here, it went up, come down, then go up. The market moves in waves, and so it is doing nothing different. It is coming down, pull back, and then it's going to come down and so on. So that's why we can wait for the higher price, for the market to reach a higher price, because it's going to wave, and then when it reaches that high price, we're going to sell it again and stuff. So what I'm looking for is past support to become resistance, right? And this is where I will enter the trade, right? So you can place one trade. It can be a position trade that's going to just sell the market and hold it down to the bottom, and then you can use other trades so that you're going to be in and out, in and out. So you can make a lot of money from just one currency pair once you believe in what you're doing and in the direction of the market, because outside of equity management, direction is the greatest thing. So you can decide to just do this. We're going to watch this. We're not going to lose this trade. We're not going to lose from this currency pair. My next videos will still be about this. We're going to watch and see what happens with this and see if the methodology works. And then in the other videos to come, I will show you how to fine tune the strategy and stuff like that. Right? But if you're willing to just place one trade and walk away, then you can just place one trade and walk away. All right. So watch this. If you have a demo account, just watch it and stuff. Engage in the process, and that is how basically I analyze the market. Oh, one additional thing I want to give you as a bonus. I think that will help your trading. Let me just put this. It's called a stochastic oscillator, and I like to use it 833. Alright, I want to show you something about this. I like to use it on the weekly time frame. I want to show you something here. This I think will do a world of good for you. Notice we already figured out the pattern on the chart, and I want you to now look at the stochastic oscillator down here in relation to how price moves. Let's draw vertical. When price is down the bottom, we said that we believe that it's going to go up. Right? If we put a line here, you notice that the oscillator crossed and then it started moving up. When price is up the top, we said that we believe that it is going to go down. If you look at the oscillator, it crossed down, it crossed and then started going down. So when that's this blue or green, when the green is above the red, you want to buy. When the green is below the red, you want to sell. And we sell and buy at the key points, at the top of the consolidation and at the bottom. When price reach down the bottom of the consolidation, then notice that the stochastic oscillator cross. So that indeed tells us it is time to buy. When it reach up the top, it's not a perfect science. It cross here and then cross back. But let's just only say that we're going to buy at the top and at the bottom. When it was up the top, it crossed again and went down. When it reached down the bottom, it crossed again and went up. When it reached up the top, it crossed again and went down the bottom. And if you only buy and sell when price was at the bottom of consolidation, you only buy. And when price was at the top of consolidation, you only sell, you would have been fine. But you can determine when you're going to go into the trade using this indicator. You say to yourself, when price reaches the top of the consolidation and there is a cross from the north to the south of this green line, when the green crosses the red, that's when I'm going to sell. And I'm going to hold the trade until price reaches the bottom of consolidation. Then I'm going to come out and then look to buy when it's at the bottom of the consolidation, and when this cross again, the green crosses the red. Right? I want you to actually think about this and stuff, because it makes trading so much easier. This is not complicated. It's really, really easy stuff and stuff. It's just sometimes we overcomplicate it, right? So the stochastic oscillator 833 on a weekly time frame. If you look at different currency pairs, I'm just going to show you one more with the same stochastic oscillator. Right? Let's go to the weekly time frame. I just want to show you this, and I'm going to leave you to practice on your own and think about this, right? And you tell me if you see that it works. We're on the stochastic oscillator. We're on the weekly time frame, and we're going to change the input to 8, change the 5 to 8. Let's just make this green brighter, right? And just look. I need to just look at this, right? Ideally, you buy and sell when the stochastic is in and around 20. You notice it has a level. It has two levels, 20 and 80. When it reaches down to 20, you want to buy. When it reaches 80, you want to look to sell. Just watch this carefully. I'm just going to use a horizontal line. What happened there? Price went up. What happened here? Price went down, and notice that it crossed. When it reaches the bottom, what happened here? Price went up. When it reached the top and it crossed, what happened? Price went down. And it reaches, you're going to probably say, is this really this simple? It is. It's just sometimes carrying it out, we just make it complicated. It crossed down here, price went up. And you can look at this at any currency pair, and you see the same process repeats itself. In other words, this can tell you when to get in and when to get out. You get in, remove this one, when it crosses out the top, right? You come out when it crosses down the bottom, or when it reaches down the bottom, right? And so if you just had done this, you buy and sell and buy and sell, and see, even in recent times, at the beginning of the year, now you can't trade every single currency pair, so you just have to sometimes decide what you're going to choose. But see there, every time the stochastic crosses, right, it changes direction, and that was your indicator to buy. So what would have been the focus at the beginning of this year for this currency pair, the pound versus the Japanese yen? Buy. Had we just bought, we would have been up profit. And that's one way you can look to trade. Right? Spend some time on this, it will help you. Alright, so this is Ed FX Trader signing out, and remember, it is God who gives you power to make wealth. God bless you.